Good morning. Hi, you're watching BloombergQuint. Welcome to all of you. Now, there were a few surprises in TCS's second quarter earnings. While close to consensus estimates, top line growth at 4% constant currency seems to have disappointed the upper end of the forecast, but that's not a very big thing. Attrition jumped over 300 basis points to 11.9%. But again, this seems to be an industry wide phenomenon, though the jump did surprise analysts in size and measure. The company has won about $15.7 billion in deals in the first half this year. That's half of what it did in all of FY21. So it's broadly on track to repeat the same performance, if not better it. Now, we're going to talk about second quarter earnings, but we're also going to talk about the medium to long term because this post-COVID scenario offers a one-time reset opportunity for all of the world's largest IT services players, including TCS. So join me in welcoming Rajesh Gopinathan, the Managing Director and CEO of TCS. Rajesh, good morning. Thank you very much for joining us here at BloombergQuint.
Good morning, Menika. It's my pleasure. Thank you for having me.
Rajesh, I'm going to start with a broad question, then narrow down to the quarter, and then look at the medium to longer term, perspective from your end. So the first broad question really is, because you speak with businesses, large and mid-sized to some extent from across the world, what's your assessment of where we are in the post-COVID recovery? Are we out of the woods?
I think so, Menika. We are definitely, there is a very broad-based optimism across our client universe and across multiple sectors. So you will see significant momentum and propensity to invest in areas like BFSI, retail, but even more so, manufacturing is attracting a lot of attention and momentum. And something which has been the most impacted, the travel and airline industry, that itself has brought forward its estimates of return to parity by 12 to 18 months. So what they were expecting to happen in 2024, now they're expecting it to be closer to 23, if not earlier. So that's the nature of optimism that we are seeing across. Of course, this doesn't take away from the fact that if something turns out in the next few months and we take a downturn, that's a different issue. But where we are going in is significant optimism across our client universe.
So you're saying the worst is over, and I don't just mean this in terms of spends towards IT services or digitalization projects. I mean, broadly speaking, corporate financial health seems to be out of the woods.
Absolutely, Menika. That's exactly the way to think about it, that they are into growth phase, they are willing to invest, and there is that optimism and back to healthy lines. Some industries will lag, but overall, it's a very strong momentum.
Okay, not that demand was a problem for you over the course of the last year and this year, but how would you characterize the quarter? Because there seems to be some disappointment on the street regarding, how the top line performance went. It did not quite meet some of the top end of the forecasts, both in dollar terms or in constant currency terms. And I think there was also some disappointment in the fact that while deal wins are healthy, there were no big mega deals. So I'd just rather hear it from you in terms of, did you think the performance in Q2 was somewhat subpar, or is this what we can expect through the course of the next two quarters?
As they say, beauty is always in the eyes of the beholder. And from our perspective, it's been a very, very strong quarter. Because it's seen in perspective that when there was significant pessimism out in the market, we were among the first to say that no, we see demand visibility and we are seeing very strong medium-term growth. And it is coming not just because of a bounce back from the COVID, but because it is coming from new investments getting triggered, driven by a significantly different technology agenda, which is getting integrated with the business model changes. And that trajectory has remained true. And it has taken some time for the markets to actually take cognizance of it and to buy into that. And there might be some overexcitement or some, short-term disappointments. But we believe that the trajectory that we are on is the same that we have called out and we have been consistently commenting about. And our confidence in it and our conviction in it is only become stronger in this quarter. Coming to the quarter's numbers itself, the way to look at it is that if you look at the segmental performance, there is very broad-based growth across. So the trifecta of BFSI, retail, North America, they are all at the doing at multi-year highs in terms of the momentum that we are seeing, and we think that that will that's a strong one that will sustain. If you look at North America coming back, which is 52% of our revenues, that's also a very big one. The deal wins itself, it's very healthy because it does not have a single mega deal in there. So to put it in perspective, compare on a year-on-year basis, on a like-to-like, it's up 25%. And this will be the nature of deals. The mega deals, by definition, will be sporadic, but very broad-based deal momentum, and coming in, book-to-bill coming in at in the range of 1.2 is very healthy and supportive of that continuing growth. So I feel that across the board, almost on all parameters, again, if you look at from a profitability perspective, the margin, if you look at where the drivers are, our employee cost, reflecting the forward investments we made in retraining and campus hiring, the employee cost has actually significantly improved. We have some challenges from the attrition that you spoke about, which is an industry-wide phenomenon. Continuing travel restrictions, that is increasing our short-term leverage of subcontractor resources. And those are tactical things that we need to deal with. But the structural elements of our business model are only getting stronger.
Okay, just a couple of more questions on the shorter term, and before I get to talent or attrition, Europe was maybe not, let's say, performing at its best this last quarter. You've articulated a bunch of reasons, both in your press conference on Friday night and the analyst conference. A large project came to an end. There was enhanced offshoring out of Europe. When does that fix itself? Any timeline to that?
It will probably be 2-3 quarters forward. We have got a strong new customer additions and new deal wins this quarter, which will take time to play out over the next quarter or 2 quarters. But getting into Q4 and Q1, Europe should be back to where it was as far as the growth momentum is concerned.
Okay, and as far as deal sizes go, Rajesh, look, I understand. I'm you made a virtue out of not having a big mega deal and having consistent mid-sized deals. But still, I think if you look at the competitive environment, do you think you're doing the big deals as best as you can?
Absolutely, Manika. Our competitiveness in the mega deals is both our appetite and our competitiveness is undiminished. But we are very particular about the nature of that deal. So if you look at even the ones that we did over 2 quarters back, there has to be a strong transformative component into which we can. It is not just the volume, it is the nature of what that scope is that we are quite focused on. And we continue to remain extremely strong in that environment. And we are a preferred go-to partner when it comes to large-scale transformative projects. So those are something that.
May I interrupt you? I was just looking at Accenture's earnings September end. 72 clients with bookings of over 100 million this year. I think at TCS there will be 50. Now I know I'm comparing apples and oranges in terms of overall size of enterprise, but still, I just like to get your sense of how do you close that gap in terms of large-sized clients, or is that a very, very long growth trajectory?
Our number is 54, Manika. And
54, yeah.
We compare that on on a revenue to revenue and client to client perspective. You will find that we are actually better placed than anybody else in the industry, and that actually is a testament to our strategy to invest as a full services provider and having the most broadest profile of services. So, and you will find that it is not just at the 100 million range. At every range of that customer metric, our numbers are steadily increasing. So that's the best way to look at it. That are we increasing our relevance to our customers? And as long as we are, and we are participating in their growth and transformation agendas, our growth trajectory remains secure and protected. And that's where all our strategic investments are aligned towards.
Okay. A short while ago, I remember Rajesh, you started offering a split in terms of revenue with regards to digital contribution. I don't think I spotted that number this year. Excuse me if I didn't. But can you provide that information on, the size of the digital business or its contribution to overall top line?
Menika, we stopped reporting that almost 2 years back. And the reason for it is that now almost every deal
Has a digital angle. Okay.
digital component. So breaking it up seemed artificial. So we stopped reporting it almost 2 years back.
So there are no pure outsourcing deals anymore, and largely digital deals. I mean, where the bulk of your volume used to be in terms of outsourcing, that has completely changed and fully sort of moved towards most deals having a digital element in it. Is that right?
Menaka, the way to understand it is that it's not that there are no more outsourcing deals or even what you classified it as pure outsourcing deals. Even outsourcing deals today come with a significant transformation agenda. So in our press release, for example, we have shared a deal that we've done with European shipping, Zim Shipping, in fact.
Yeah.
So it is a classical outsourcing deal. But if you look at the nature of the deal and even the nature of the client commentary, there is a significant automation and analytics based transformation as part of that. So they are looking to leverage that transformation, though the structure of the deal is a classical outsourcing kind of deal. So it is not that outsourcing deals don't exist. It is becomes part and parcel of almost every form of value proposition, whether it is pure outsourcing or it is a very growth and transformation kind of proposition.
And therefore, does this sort of look? I know you've done extensive commentary on margins, and I'm not going to sweat over a few hundred basis points here or there. But I just want to understand over the medium to long term, does that change the profile of margins that you can expect? The fact that almost every outsourcing deal has a largish or mid-largish digital component to it, can that influence or help you improve margins, even if you were to choose to reinvest some of that money?
Actually, if you think back to our conversations over the last 10 years, right? And we have always maintained that our strategic agenda is to maintain stability in the margin front,
Yes.
right? And to make sure that our investments and our portfolio of services addresses that stability, right? There might be volatility, a few percentage points up, few percentage points down, as you said, but the strategy is more on maintaining that and to make sure that we are relatively competitive to be able to command that that performance premium. And that is where the approach is. We are not trying to structure a service portfolio to significantly increase the margin profile, but definitely we are structuring it to make sure that our relative competitiveness stays high so that we are able to defend our margin profile.
Sorry, one more question related to that then, very quickly, before I get to the medium to the long term. And that is that, given that for, let's say, some of your larger competitors, and I mean, it makes only sense to me now to compare TCS to the largest company in the world when it comes to IT services, or at least, outsourced IT services in this area of the business segment. Let's say Accenture, right? Consulting is such a big part of their business, where it isn't necessarily as yet yours. There was some improvement over the last couple of years in the contribution to revenue, but it still isn't comparable in that sense. And so I'm just wondering, how do you get to that level of pricing or margin, if I may call it that, or am I reading it incorrectly?
I would definitely want to build something that is far superior to what the legacy consulting model is. So if you look at it, the total value addition as reflected in the profit that we're able to generate clearly points out that the legacy consulting business is not a very attractive one. So what is required is a complete reimagination of how we go about it. And that is what we are trying to achieve by what we call our inside-out transformative approach, where we are expanding from the contextual knowledge that we have and going into the adjacencies of the transformation agenda and participating and co-innovating along with our customers, rather than coming in on a top-down transformation agenda, which is to try and disrupt the existing setup. So it is a philosophical call, but we are very clear that what we are seeking to achieve is an extension of our business model, which has been industry leading in the past, and I believe that there is an opportunity to build out something like that in the future.
So that from the way you describe it and the way I understand it, that gives you a better entry point maybe into the consulting business. But does that give you scale over a period of time?
It will be a slow build out, absolutely, because it is, as I said, it's a step-by-step salami slicing kind of approach, but it is structurally more robust and much more integrated to our business model. So what we are currently seeking more than scale is breadth of participation. So what we are trying to build it out so that we are doing these engagements with as many of our customers as possible. Because as we get that breadth of engagement going, it will get deeper into our service portfolio and into our larger account teams, and it will give that runway for growth. So we are in that investment phase where we're seeking greater participation on a breadth rather than the size or scale of individual engagements.
Are there targets we can use to see what your performance will be like in this area over the course of the next several quarters? Maybe you have a goal in mind in terms of percentage of this new, not legacy consulting, but this new consulting division or new consulting business towards your top line?
Yeah, Menka, we are very careful exactly not to classify it the way you said that it's a new consulting division, because then it brings in a duality into the core account team. Whereas what we're trying to do is to make sure that it is one single whole. So what we are trying to do, if you look at our public press statements and what we are sharing, we have significantly increased the volume of individual instances that we're sharing to give you a color of what is going on. And we are also being very specific about actually naming customers, putting out customer codes so that you get a validation of what's going on. The quantitative sharing will take time. And today it will be, dysfunctional for us to do it from an internal perspective rather than adding on to the strategy. But at a later stage, if it starts to get to a size where we believe that it makes sense, we will do it. Till then, it will be more qualitative commentary.
How long will it take to become a significant size? You can't give me a number, then give me a timeline.
No, but more than the number, and actually, if you look at it, see, the kind of examples that we're quoting with names of customers, the work that we're doing for the work we were doing for OpenReach, NXP Semiconductors, Wabtec. So each of these, Jinsei Dege, and we are giving specifics of what we're doing, and the clients are endorsing what we're doing. Right? That is the bigger one. As I said, we are seeking participation, and that will be seen through the number of customers that we're talking about, rather than this individual size.
Okay, let me talk about attrition, and I don't really only just want to talk about that number because, as I said in my introduction, and as you confirmed, this is an industry-wide phenomenon. I think Accenture's, attrition rate in the fourth quarter of their August-ended year was 19%. So, and I'm sure you're still at the lower end of what your peers in India are, but it is still over 300 basis point jump in the period of a quarter. So I want to understand how you're looking at it. I know you've increased hiring beyond what was expected to happen in the first half, and therefore your overall hiring for the full year will be more than earlier estimated. I think you're looking at maybe 78,000 in FY22 versus an earlier estimation of about between 40 to 45,000, if I understand correctly. Talk me through what this talent problem is. Is it a problem? Is there an opportunity to it in any fashion? How it plays into your costs and margins? And when do you think it might resolve itself, let's say, over the next few quarters?
So, Enka, when we started speaking about this, the demand environment about a year back, right? And we were counter industry narrative in that, and we called out the strong demand environment that we're seeing in the future. We backed it up by increasing our campus hiring. And we also, so what we've done is, while we said 45,000, we onboarded those 45,000 people in the first half itself, which gives us the space to onboard more to the second half of the year. So we have taken a very structured approach to that capacity addition in line with our own expectation of demand. We also significantly increased our internal training. And we were the ones who went out and said in the pandemic that we are not going to retrench anybody. because we believe that this is a passing phase, and these are the people that need to be trained and retained as we go forward. So very strong doubling down on our internal talent, retention of the talent, investment into it, and then very strong hiring on the campus side. These were all in anticipation of the demand. Parts of the industry did not participate in that, and therefore there is this significant crunch that you're currently seeing, that everybody is trying to scramble to meet the demand that is there. So coming to your point as to how long this will last, probably it will last a few more quarters till the individual supply chains at each of these levels stabilize with the more longer term hiring. Till then, this extreme lateral movement will continue. But I would think that by the time we get into the middle of next year, Q1, Q2, bulk of this would be behind us, and we would be in a more stable but elevated attrition. See, we are currently at about 11.5 on an LTM basis. We have been at 12, 13, and we have had a peak of 16 in the past. So in a high demand environment, 12, 13 is something that we have seen in the past also. That's not a, but the significant increase quarter on quarter, that will start tapering off in a couple of quarters.
Okay, so you're preparing us for maybe, and I understand it's a volatile situation, maybe a worse attrition number, but you're hopeful that it will ease in Q1, Q2. Really, how does this hurt your ability to maybe achieve the growth that you want to, because you just don't have enough people on your end? Again, I point out before you point out that it's not just a TCS phenomenon, it's an industry-wide phenomenon, but really you are the leading company in this business, and therefore your opportunity to grow is dramatically more than any competitors, right?
So, Menaka, again, as I said, having spotted the demand opportunity early and invested into that capacity side, currently it is not yet impacting our growth momentum, the capacity crunch. But our bench is getting squeezed with the kind of attrition that we are seeing, and it is not a stable one. So we are offsetting that by this more, what you pointed out, the more aggressive campus hiring, and also more tactical lateral hiring that we are going on. So currently, it is not impacting our ability to meet the demand that is immediately with us or that we see. But this is something that we need to be very vigilant on and stay on top of it. And that's where that 75,000 comes in.
Okay, let me ask you this way. Do you think that you might, if you wanted to hire more than, let's say, 78,000 people in the full financial year, is there an opportunity available for you to hire? Is there talent out there in the market for you to hire? Are you constrained by the talent pool?
Absolutely, we're in a good position to hire, Menaka. See, 70% of what we are currently hiring, in fact, more than 70%, is coming to us directly. And the investments that we have done in that TCS National Qualifier Test and the platform that we have created, more than 350,000 people participate in each of our hiring waves. So, we are still hiring on, 1/5 or less of what people are trying to apply to us. And we have done this in a very digitally transformative way. The ones that who are near but did not qualify, we go back to them and share with them the areas where they were short on, because they are interested in working for us, we are interested in them. And if they use the opportunity to skill themselves, we are very interested in bringing them on. So that digital platform that we created, what we call the TCS National Qualifier Test, that's a hugely powerful data set that we have, into which we are constantly mining. That's why we are able to, midway through the year, say that I'm going to go from 45 to 75, because we have the pool available with us.
Your hiring abilities and the ability to scale, and I think we caught just about the last word of your answer. So let me come. I think you're at what 528,000 employees roughly now.
Yeah.
Okay. So Rajesh, I'm going to ask you this question. I think some part of the answer is already known to me, but I still want to ask you this question to see how you're going to respond to it. I'm looking at revenue per employee. We spoke a little bit about the consulting model that some of your largest peer has, and Accenture has 624,000 employees, total revenue of 50 billion in FY21. You're at 528,000 employees with an estimated total revenue of around 25, 26 billion this year. Does that metric change anytime in the near term over the next 3 to 5 years? The number of people to the size of the revenue?
That's not a metric that we target per se. As I said, in most areas, you will think of value addition per employee, right? And the economic value addition per employee that we have is actually much higher than, or almost, I would say 70-80% higher than the next largest competitor. And that's a more important metric because the key resource for us is the employee. And for each employee, are we able to create that economic value is the key question for us. And we have built our model to maximize that. And that puts us in a very...
I'm so sorry to interrupt you, but can you explain to me what that means? Because isn't revenue per employee the same thing as what each employee is worth in terms of total output?
No, the economic value added is best shown in terms of the economic surplus that is generated, which is the profit. And if you look at it in terms of profit per employee, we are almost 80% higher. And that is the true measure of what is the value addition at an individual employee level. And what is it that the customer is ready to reward you with. And
doesn't that have a direct linkage to costs necessarily more than or cost or wages or salaries or remuneration per employee? I'm just trying to understand this.
It's a free market and everybody is in the same space, in the same operating model. So it's a question of there will be areas which will generate high revenue with zero value addition. There could be very, very different businesses. Our focus is to be in the business spaces where the value addition is most. And that's the metric that we are tracking. And within that spectrum, we believe that the adjacencies that we're seeking on the growth and transformation will actually continue to help us deliver on that. And that's the investment that we are making. So the metric that we're chasing is a different one.
Okay, I'll come to growth opportunities. This is the last theme that I want to talk to you about for the next couple of minutes, which is, what I mean, I know what your inorganic strategy has been over the course of the last decade or so. But do you think that maybe, let me put it this way, how many businesses have you acquired, let's say, in the last 12 months?
12 months, none.
Yeah. So do you think you might be missing out on a growth opportunity by choosing not to have a very aggressive inorganic strategy? Because I look around at your competitors and some of them have grown substantially by acquiring small to medium-sized firms across the world, right? I can put numbers and names to that, but first let me get a broad answer from you before I get more specific.
Our company has been characterized by building out a strategy that is unique in the industry and executing diligently on it, right? So there will be different strategies that different people will follow and different philosophies that different people will follow. I don't see us significantly going away from our strategy and our philosophy, considering the success that we have enjoyed and the value creation that we have actually enjoyed. Having said that, ours is not a 100% organic strategy. We are very, very selective, but we are very successful in our inorganic strategies. And that's why, as I said, we participate, but we are careful about what asset we want and what price we are ready to pay for it. And as long as it meets those two criteria, we are very keen to pick it up. So our strategy is a very deliberate, a very disciplined inorganic strategy, but it is different than others. And we are quite happy with where we are, and I'm sure others are too.
Yeah, no, so again, I don't mean to make this an onerous comparison, but how else can one benchmark, a company of your size, except to look at a global peer that's maybe substantially larger, but still is, using this strategy in an aggressive fashion, right? For example,
It is not the
46 acquisitions worth over 4 billion in FY21 at Accenture. And I can't help but think that that is an effort or a way to target specific growth areas, specific, talent segments, specific knowledge segments. So I'm just wondering whether if the largest player in the business is doing this, is there more growth available through a more inorganic, aggressive strategy?
Let's put it this way. That's not the only way in which we are different from many others, right? So, as I said, it's a different strategy, a different philosophy, and it is, I think, does not make sense to unbundle individual elements of it and compare it. We definitely are not seeking growth through inorganic route. We are looking at capability enhancement, market access, which in turn can lead to growth. So we are not our strategy is not 0-1-1, but it is more organic than aggressively inorganic. And that conservativeness on the inorganic path is likely to continue because we are building the entire organization around that structure.
So bear with me as I persist with this with this theme. One more question. At a time when demand is very high, and I'm sure you agree with me, this is a one-time reset, right, for a large part of the business world across countries as they pivot towards a more digital strategy. At a time when demand is so high and supply is difficult, as you articulated yourself earlier in the interview, would not an aggressive inorganic strategy allow you to capture more growth in these early years of that demand? Because eventually this will all, in 3 to 5 years, maybe 7 years, this will all get completed. This will be a one-time reset. So it doesn't make sense at this point in time, or how would you best attack, the fact that this is finite, 5-7 years, and therefore maybe this is the best way to do it now or not do it now?
You probably, Menika, you put it best, because the difference in the way we are looking at it versus the way you are characterizing it is, we are looking at it as a once in a decade opportunity. We are looking at it as a once in a one-time reset. It's not a one-time reset. The similar situation will come after some time. So what's important is that our growth strategy should be internally consistent and sustainable. And that is why the strategic coherence and the strategic discipline is important. And it is not that this strategy is superior or that strategy is superior.
Sure.
What matters is, are you staying true to your strategy and are you building your structures and your processes on that strategy rather than vacillating between one or the other? So we do believe in the strength of the demand environment. We do believe that this is a cycle and which will keep repeating. And what is important for us is to build out on this on a consistent, disciplined manner. And the opportunity universe is almost infinite.
So sorry, just to go back to what you said you don't think this is a one-time reset, that you think this is a decade-long opportunity or maybe even longer than that?
I didn't say decade long. I said it's a once in a decade.
I'm putting words in your mouth, but I need to, because how else will I get sense of how you see this?
As I said, it is a repetitive one. See, this is an architectural change which is triggering a lot of shift. Now, there is no reason to believe that this will be the end of all architectural. There will be continuously new areas that will open up, and so we have to maximize what is there currently, but we also have to build out, knowing that it is not going to be that this is the only one. There will be new ones coming. So that is why our strategy of organic talent development, of investing in our people, of continuous retraining, of doubling down on our customer relationships, that is so important, because when you think of it as continuous waves, what you're trying to stay is to stay on top of the wave rather than just try to maximize at one single point in time. And that's the philosophy, right? And within that philosophy, the organic or the being more organic than inorganic plays into that. And that's how we are building out our structure and processes.
Okay. So then last question, I mean, since this is going to be not necessarily a one-time reset, but maybe a decade or longer opportunity. What do you see as the evolving new growth areas over that decade? I already know that you mentioned that cloud is still only at maybe 20 or 30% of what its potential could be. And so there's a long way to go there. We know many of your earlier business lines that you've already done very, very well in. So I don't want to discuss BFSI or retail or supply chain, but I want to discuss if you see newer opportunity come in blockchain. I did notice that you've done a couple of transactions there or a couple of deals there, if I may say so. Security, which seems to be right now more of a consulting game than necessarily the way you approach it. Broad areas of growth over the next 5 to 10 years that you think could substantially change your scale game?
Actually, the service line part of it is a more dynamic one, and whether it is blockchain or security. Security, I disagree with what you said, but let's stay with the.
Okay.
I think the better way to think about it, and we don't have specific answers, but I'll tell you where our mind is and what we are building out. So we are really talking about 5-year plus kind of a horizon. We have looked at the world from a very vertical industry perspective. Whereas what the world is going towards is much more converged structures. So whether you take what is happening in the whole EV world, right, the whole case phenomena, the value proposition is a much more integrated proposition than a single vertical industry proposition. Same is the case with what is happening or what will unfold as the 5G world rolls through, because it's a much more integrated proposition which will cut across individual vertical lines. So the structures of tomorrow will be more homogeneous than the more verticalized structures that we are currently seeing, and we need to build ourselves out into these convergence points, and that's where the opportunities will lie. And as I said, that is the direction that we are going towards. I don't have specifics to share with you, but the way to think about evolution is that, because the service evolution will keep on happening. Security is something that security today is a lot more about getting it done than consulting about it, because it is about executing it and building it deep inside the organizational systems and processes, rather than somebody doing outside in consulting on it. Same will happen with others. It will start as something that is a theory being discussed. It will come into the
sustainability, for instance. You spoke of EVs. I think there is now a broad opportunity available in how companies are approaching sustainability, right?
Absolutely. So if you take of sustainability, it has implications for BFSI, it has implications for manufacturing, it has implications for the entire gamut of regulatory aspects of it. So these will be the themes that are cross-industry, and that is where the leaders of tomorrow will come. And how do we position ourselves to participate in that is the direction that we are thinking about. So the concept of domain will go away from being vertical domain to being domain-centric in these areas. So how deep is your understanding of 5G? How deep is your understanding of sustainability or of EV case, those kind of areas, and building out those ecosystems. And we call it internally saying that going from a product-centric approach, for lack of a better word, a purpose-centric approach, that what is it that the customer is seeking to achieve, and how will you deliver that? And that delivery will be through an ecosystem of traditional products or industries, rather than by those vertical slivers. And this is very exciting, because every time there is a structural change, it actually opens up significant investment opportunity. And positioning ourselves to participate in that is the important thing. So we are quite, that's where this, as I said, we don't see it as a one-time reset. It is about shifting on to a different trajectory, which has a lot of possibilities.
Yeah, so when I say one-time reset, I don't mean that the opportunity will die after that, but what I meant is that the bulk of the change that industry wants to take place from a digitalization point of view, etc., will maybe play out over the next 5 to 7 years. But your point well taken. Rajesh, my final question to you, and this is a medium to long-term question. It's also a slightly fuzzy question, so you'll forgive me for that. it's no point comparing you to many of your Indian peers because your size now is just incomparable in that sense. But again, I can't compare you to maybe an Accenture, which is twice the size, though I've tried to in this interview. How should we be seeing TCS over the next 5 to 10 years in terms of its ability to scale, in terms of its ability to grow faster, not than the smaller Indian peers, but maybe even the large global peers? Where do you see the competitive threats coming in over the course of the next 5 to 10 years? Like today, when I look at IT services, not just outsourced, there are many, many large players. That are doing faster growth, maybe even. So, what would your way of looking at this be?
Priyanka, a lot of questions bundled into one. So let me answer at least one, and then we'll save the others for later.
Okay, thanks.
The way we are trying to seek is that growth is important to us. We have an internal saying that growth is the source of our energy. And growth and momentum is important to us. And our strategy is to ensure that we maintain growth momentum so that we can constantly transform to stay relevant and keep this as a sustainable model. So there is no absolute growth threshold that we are seeking, nor are we seeking to be the highest growth or the by X numbers or in X market. What is important is that as an organization, can we have a healthy growth? And for better or for worse, we kind of defined that saying, can we get to a double-digit growth, right? And that is just a number in the sand, as it were, or a line in the sand. But important thing is, can we continuously grow? Because that will show us that we are relevant to our customer universe and we are positioned in the right places. And it will give us the momentum to continue investing to keep ourselves relevant to customers, and that will maintain the sustainability of our business model. That is the medium to long-term perspective at which we are going. What happens around, and we will remain competitive, and we will compete with different segments at different points in time. But if you stood back and, as you said, if you think about TCS, you should think about TCS as somebody riding a cycle. You got to keep on moving, and you got to make sure that your balance is there. Then it's you can enjoy the ride and go a long distance, and that's what we are trying to structure ourselves for.
Okay, that's a very conservative answer, Rajesh. I'm not surprised. TCS has always been conservative when it talks about these things and different about delivery. But still, I mean, isn't this an industry that's going to grow? You'd have to do something very wrong to not be able to get growth, right? I mean, given what a well-oiled machine you are, you'd have to make some really big strategic errors to not get growth. So is it just enough to be a person on a cycle? You don't want to be the guy driving a Lamborghini?
No, absolutely. I think we are set up for being a person on the cycle and who cycles far and cycles well, right? But it's not an industry where growth or sustainability is a given. Okay, it's a very unforgiving industry. You get off the line, you will get thrown off. Not that you cannot recover, but then it takes a lot to recover, and that also you have seen play out. So getting overexcited is not necessarily a great thing. Staying conservative, staying true to who you are, and playing for the long haul, that has its own merits, and that's where we are, where we are positioned. And I think we are fairly transparent about it to all our stakeholders, whether it be employees, customers, or investors, and they value us. So we must be doing something right, and we'll continue doing that.
Sure. I'm not damning you for being conservative at all. I was just curious to know how you see the trajectory for growth and opportunity over the course of the next 5 to 10 years. Rajesh, always pleasure speaking with you. Thank you so much for sharing the insights on the business, both in the short and the medium term and the long term. And thanks for your time today here on BloombergQuint.
Always a pleasure, Menaka. Great speaking to you.
Thank you.
Bye-bye.